On this issue of Retirement Crusaders, we'll look at 7 ways retirees can slash their tax bill. Okay, so let's dig in. Number 1, if you have a regular IRA where the money is growing tax deferred and some money in a Roth IRA where you've met the qualifications, the money's been in there at least 5 years, always withdraw from the Roth IRA first. That money is tax-free. You want to let the tax deferred money grow as long as possible. Now, some people do not quite grasp this whole idea of tax deferral. They think, well, if I've got to pay the tax anyway, what's the difference? Well, there's a big difference, and let me show you what that difference is. Here's a table. Let's just deal with a couple assumptions. We see that we're going to assume there's an 8% annual return on the money invested, and that this taxpayer is in the 24% tax bracket. Now, in this first column, not tax deferred, we have an investment where somebody's invested $100,000 and it's growing at 8% a year, and each year the taxpayer must pay the tax on that 8%. So after 20 years, there's $325,590 in that account. And if the investor withdraws the balance, there will be no tax on withdrawing the balance because the tax was paid every year. Now, on the right column, we have a tax deferred account. Same starting $100,000. The money's growing 8% a year, but it's not taxed each year, so it grows to $466,100. And then when the taxpayer goes to withdraw it, they would pay the tax of $111,864. I'm sorry, $111,864. Now, they'd be left with $354,240. Notice that in the tax deferred account, they wind up with $30,000 more dollars. Why is that? Because each year when the taxes don't get paid, they also earn 8%. So the value of tax deferral is extreme. Now you might say $30,000 over 20 years, what's the big deal? Well, instead of $100,000, what if we had invested $1 million? Now the difference would be about $300,000 over 20 years. Pretty significant, wouldn't you agree? Next issue, capital gains. Most people can probably get away with 0% tax. Let's look at this table. We see that on capital gains and qualified dividends, those dividends that meet the criteria, which you've owned the stock at least 61 days out of the 120 days before the next dividend date. So most people, if you're not trading stocks very frequently, your dividends will be qualified. So we see that for a married couple, they can have taxable income up to $89,250 and pay 0% capital gains tax. Now, remember, that's taxable income. So because you get a standard deduction of $27,000, it means your total income could be something like $116,000, and you'd still pay 0% capital gains tax. Therefore, if you know that if you took a lot of, say, stock and sold it all in 1 year, it would push you over and above $116,000 of total income. Don't do that all in 1 year. If you want to harvest your stock, take amounts each year that will keep you in this 0% capital gains bracket. So, in other words, a little bit each year, harvest your gains. For single people, that amount is $44,625 of taxable income. They get a standard deduction of about $13,000, so it means they could have total income of about $57,000 and still pay 0% capital gains. So take advantage of that and time the sale of your stocks so you're doing a little bit each year and always paying 0% capital gains. Now that's 3 tax savings ideas so far. So please, to see other videos like this on saving taxes or getting more retirement income, please hit the subscribe button below and the bell icon so you'll get notified when we next post a video. Next item, capital gains on a sale of a residence. It may make sense from a tax perspective to actually sell your residence and move before the gain on that residence becomes too large. Why? A married couple, the first $500,000 of gain on your house is tax-free. So let's say you bought a house for $500,000. It's now worth $1 million. Sell it, you'll pay no capital gains tax, provided you've lived there in 2 of the last 5 years that you've owned the property. Now let's say you don't move and you continue to live there, and you sell it years later when the value is now $1.5 million. Well, your gain would be the difference between the $500,000 and the $1.5 million. You have $1 million gain. $500,000 will be free of tax, but you'll pay tax on the other $500,000. So it actually makes sense that over time, each time you have a gain of $500,000 in a residence, sell it and move and buy a new residence. If you again accumulate a gain of $500,000, sell it and move again. That level, of course, is half, or $250,000 for a single person. Next issue, tax-free bonds or municipal bonds. These may not be worth it for quite as many people who think they may be worth it. Let me show you this table. Here we have on the left side different durations: 1-year bonds, 5-year, 10-year, and 30-year. The first column under Muni, we see what those current yields are. So for a 1-year tax-free bond, you get 2.72%. For a 30-year tax-free bond, you get 3.56%. The next column shows what those yields are if you invest in a treasury security. So for example, a 1-year treasury security gets you 4.67%. In order for somebody to benefit by investing in the municipal security with a lower interest rate, they would have to be in a 42% tax bracket, which is very, very few people, because the highest federal tax bracket is 37, and let's say they live in a state with 5%, 37 plus 5, that's how you could get to 42%. But there's very, very, very few people in that range. So it would not make sense for hardly anybody to buy a 1-year municipal security, because the tax savings will not offset the tax that they would pay if they just bought a treasury security. And the treasury security, by the way, there wouldn't be any state tax anyway. Now, if we look at the 5-year bonds, we see that the tax bracket needed for it to make sense is a little less, 36%. So a few more people might qualify as it being viable to buy a tax-free security versus, say, a treasury security. It's not until you get out to a 30-year security, long-term bonds, that you see that there's a very small tax bracket needed in order to justify buying a tax-free security. Because on 30-year securities, we see that the tax-free security yields almost as much as the treasury security. So at 30 years, we see that the tax-free security yields almost as much as the treasury security, and somebody in a very, very low tax bracket would actually benefit by the tax-free security. So here's what I'm saying. Right now, while I'm recording this video in January of 2023, the rates are such that unless you're investing in longer term bonds, tax-free bonds would not be justified for most people. So before you jump and think, ooh, tax-free, that's what I want, you or your financial professional must do the analysis and see, would it actually even pay for you? Next issue, let's talk about immediate annuities. They have a special type of tax deferral that could be useful to a lot of retirees. So the way immediate annuities are taxed, let's take this example. You invest $100,000 and you'll get payments over your lifetime. Now, based on your life expectancy, those payments would total up to $140,000. But only 29% of that $140,000 would be taxable. Why? Because the way IRS looks at it, they say, well, if you invest in 100 and you're only getting 140,000 back, part of each payment is really return of your principal and is not taxed to you. So only 29% of each payment would be taxed. Now, so the rest of your payment is not taxed, but if you live beyond your life expectancy, so say, for example, if you're 65 years old, your life expectancy is, say, age 83. If you live beyond age 83, then each payment that you continue to get from this lifetime annuity would be fully taxed. Now, the next question is this worth it? Are immediate annuities a good thing to invest in because of these tax savings? The answer is not right now. Let me show you why. Right now, if a 70-year-old male invests $100,000 into an immediate annuity, a lifetime annuity, he will get $737 monthly for life. Now, if his life expectancy is 14 years, that would only come out to 3.15% a year on his money. Not a great return. Why bother? You could just go out and buy some treasury securities and not bother with it. It's just not a substantial rate of return. When does an immediate annuity pay? Well, if you have genes in your family where everybody lives to age 100, should this investor live to age 100, because those payments are lifetime payments, they will go on continuously for the rest of his life, then the return comes out to 8% a year. So you see, immediate annuities are only really good, at least at today's rates, if you think you're going to live a long time. If not, it's an investment you want to pass on, even though it has some attractive tax benefits. Next is the issue of the tax you pay on Social Security benefits that you receive. We did a whole video just on that topic, and you can see, I think it's going to be over here, if you want to click on that, and I'll also have it at the end of the video where you'll be able to click to watch that entire video, which is just on the issue of how to eliminate tax on the Social Security benefits you get. Now, the last and seventh issue we'll talk about today is something called ordering. Ordering means the pots of money from which you withdraw money during your distribution years, during your retirement years. And I alluded to this at the beginning of the video, that tax deferral is really valuable. So let me show you just another example of the same basic idea. Let's say that you have two pots of money. You have $100,000 in an IRA, a traditional IRA, and $100,000 in a savings account. And over the next 20 years, you need to withdraw, you need to have $6,000 from these accounts to spend, okay? So you've got to get $6,000 in your hand in order to spend. And the assumption is that you're in a 33% tax bracket. So in our first scenario, we're going to spend the regular money first, the money you have in a savings account. So each year, you withdraw your $6,000. Of course, whatever money that account is earning, that's 6%, you're going to pay tax each year because it's just a regular savings account. So what happens is, at the end of 20 years, that regular money will have been reduced from the original $100,000 down to $40,916. But the IRA money you wouldn't have needed to touch. It just keeps growing, and that will equal $320,000. Now, let's take this other scenario where you start with these two pots of money, $100,000 of IRA money, $100,000 in a savings account. But you decide you're going to spend the IRA money first. Well, here's the problem. In order to have $6,000 to spend, you've got to withdraw $9,000 because a third of it will go to taxes. So you withdraw $9,000 to have $6,000 to spend, and over those 20 years, you would have not only exhausted the money in the IRA, but you would have had to use some money from the savings account in order to have $6,000 every year. So you would have been left with $211,247. So by spending money in the right order, we see in the first scenario, you're left with a total of $360,000. And in the second scenario, only $211,000. That is a huge difference. That is a difference of $150,000 over 20 years on $200,000 of original capital. So just by spending the right pots of money first, you will have more money during your lifetime. Now, you might argue and say, but wait a minute, Larry, if my children inherit my IRA, they'll have to pay the tax. My answer to you would be, so what? They inherited money that they didn't lift a finger for. Shouldn't they have to pay the tax on it? Why should you have to pay the tax on it? Now, if this type of information is useful to you, we have additional resources. In the description below, you'll find a link to our 10 free booklets on different retirement financial topics. So please click and enjoy those booklets, and you'll find them to be really useful information. You can also join a link. There's a link to join our Facebook group. So please click that, and we'll make sure and give you some great value there, where you can also interact with other retirees about different financial issues of retirement.